Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson we looked at the Consumer Confidence Index, an indicator which is meant to give insight into how the consumer feels about the economy, which normally affects consumer spending. In today's lesson we're going to wrap up our discussion on the top level of fundamental analysis with a look at an indicator that combines many of the leading components of the indicators we've studied up to this point into one indicator known as the Conference Board's Index of Leading Economic Indicators. So let's get started.
Okay, the Conference Board's Index of Leading Economic Indicators is made up of 10 sub-indices which tend to move ahead of the overall economy. The index is published around the 21st of each month, and it's an interesting one because, as I talked about a little bit in last lesson, it includes many of the leading components of many of the indicators that we've studied up to this point. And it's designed to predict the business cycle, so to speak. So there's a lot of insight provided into this interesting indicator here. The first component of the indicator is the average hours worked by manufacturing workers. The reason why this is seen as a leading indicator is, excuse me, before hiring or firing employees, manufacturing firms will normally increase worker hours when demand requires, or cut back worker hours when demand falters. Since most manufacturing laborers are hourly, it makes it easier for them to do this than many other firms. So that's why it's a good leading indicator there. Okay. The second component is the average number of initial applications for unemployment insurance. It's probably obvious here that if the number of applications for unemployment increases, this means more people out of work, which means, people will have less money to spend, which means a weaker economy and market sell-offs, all else being equal. Okay. The third is the amount of manufacturers' new orders for consumer goods and materials. An increase in this amount of new orders should indicate a pickup in demand and vice versa. Okay. The fourth is the speed of delivery of new merchandise to vendors from suppliers. This is a leading indicator because an increase in demand can cause an increase in delivery time as suppliers have trouble keeping up with the new demand and have to add staff and those types of things to do that. Okay. The fifth is the amount of new orders for capital goods unrelated to defense. Another way of looking at new orders, which should lead the business cycle, is pickups in new orders indicate rising demand, which should mean increases in economic growth and rising markets, all else being equal. Okay. The sixth is the amount of new building permits for residential buildings. As builders try to anticipate demand, new building permits normally move higher ahead of demand, which is why this is considered an economic indicator, because it takes, 7 or 8 months to build a house is probably an accurate estimate. So builders have to move ahead of the curve, so to speak, to anticipate demand and try and move ahead of the curve to anticipate, slack and demand, so they don't build too many houses. Okay. The seventh is the S&P 500 index. As we're going to learn in our lessons on the stock market, the S&P includes the stock prices of the 500 largest companies in the U.S. And as we've learned in past lessons, markets anticipate making changes in stocks that make up this index, a leading indicator of economic activity, as market participants such as ourselves try to anticipate what's going on. It makes that a leading indicator there. The eighth is the inflation adjusted monetary supply, or M2 it's referred to. In simple terms, this is watched as it's a measure of bank lending, which increases ahead of economic expansion and decreases ahead of contraction, which is what makes this a leading economic indicator. Okay. Number 9 is the spread between long-term and short-term interest rates. Okay. As we learned in our lessons on interest rates, normally the shorter term the loan, the lower the interest rate one will pay. Okay. This is considered a leading economic indicator, as when the distance between when the distance between the short-term interest rates and the long-term interest rates narrow, this is indicative of a situation where market participants are anticipating Fed interest rate cuts, which normally come during an economic slowdown or vice versa. Okay. The 10th is consumer sentiment. This indicator, measures how optimistic the consumer is about the economy. And this is the, part of the consumer confidence index that we talked about yesterday. That's the leading part of the three components of that. Okay, so when the consumer feels that the economy is not good or is not expecting it to be good several months from now, they're going to normally pull back on spending, as we learned yesterday. And if they feel like it is going to be good or is good, they're going to increase spending, all else being equal, which should result in economic growth there and vice versa. All right, so as with all indicators, we cover what the market focuses on with this indicator. When this indicator is released, also depends on what's happening in the market at the time. So the best way to learn how to incorporate this indicator into one's trading is to follow the indicator in real time. So with this in mind, like with all the other indicators we've studied, I'll be posting a discussion piece on this lesson on informedtrades.com after the next release. You can find a link to that lesson on Informed Trades if you're watching this on YouTube in the description section of the video there, so you can follow that discussion. Okay, I've also posted a link to the latest release, which you can find just below this video if you're watching on informedtrades.com, or in the description section if you're watching on YouTube. Okay, that's our lesson for today, and that wraps up our session on economic indicators. In tomorrow's lesson, we're going to round out our course on the basics of trading with a look at how to choose different markets to trade, and then build a trading plan after that, and a series of lessons that goes into that. And then we'll start getting into specific lessons on specific markets, such as the Forex market and the stock market. Okay, so we hope to see you in that lesson. As always, if you have any questions or comments, please feel free to leave them in the comment section below, and good luck with your trading.